Thank you, everybody, for joining us this morning. This is indirectly part one of a two-part prep series for the students, by the students, prep series for the REIT Symposium next week. I'm Scott Robinson, clinical professor and director of the REIT Center here at NYU SHAC, and I'm really psyched not only for these two prep series, especially today. This topic's near and dear to my heart, but I'm especially excited for the REIT Symposium next week on April 7th. It is the first time the symposium's back in person since 2019. We, of course, had the Capital Markets Conference and Wire, the Women in Real Estate Conference last fall in person. But of course, I'm a little bit of a REIT snob, so I'm pretty psyched for us to be back. Plus, it's a very, from an academic point of view, Professor Harris might disagree as a practitioner, but I think it's a really exciting time to be in real estate. There is just so much change going on. From the evolving COVID economy, the impact of our migration to a definitively digital economy, not to mention geopolitical issues and of course inflation, all of which is really strongly connected. So again, the point of today's conversation is to give students an opportunity to talk about and think about topics that are going to be discussed at next week's REIT Symposium. I think we don't have anything definitive on the panel, on the agenda for inflation, but we are going to hear about it literally in every panel. It's driving the conversation from investors' point of view. It's driving the conversation from capital allocators and operators, REIT managers' points of view, and of course, everybody in between. So what I want to do today is hand the baton over to Ivan and Jacob, two of our many rock star students who are also involved in Blueprint, who've been pulling together a lot of research. This is their event. They've got some insight they're going to share with us, and then they're going to discuss and hear from Professor David Harris, who is not only a professor here, but he's also a REIT portfolio manager and has strong views, most of which I agree with, but I'm always happy to spar with him on inflation. So maybe with that, Jacob, the floor is yours.
Sounds great. Thank you, Professor Robinson. Thank you, everyone, for joining today. And thanks, Professor Harris, for being my guest speaker and keeping me in check so I don't spread any wrong information or anything. Yeah, so I guess we can move on with the presentation. As Professor Robinson said, this is a lead-up event to the REIT Symposium. Blueprint and the REIT Center will be hosting one more webinar Friday. But yeah, more on that later. So let's dive in. I'm going to share screen. And just to give you guys a little background on our agenda today, I think the plan is to go through this presentation, and then we'll segue into some discussion with Professor Harris, some Q&A, and then we'll take questions from the audience. So feel free to get some questions ready and drop them in the chat, and we'll get to them shortly. All right, so impact of inflation on CRE and REITs, not just REITs, CRE too, as discussed. Here's a little table of contents. So yeah, as Professor Robinson touched on, Blueprint is a research publication. I started working with them last fall. It's been great. If any of you students are interested in joining, this presentation should be shared after the recording is done, and you can follow us on Instagram, LinkedIn, check us out online, NYU Blueprint. It's a great opportunity for students to dive further into pretty much any topic that involves real estate that they're interested in. All right, so let's dive right in. So I think ever since the beginning of the pandemic, we've been hearing the buzzwords of, the Fed and interest rates and inflation and, what exactly is going on. So hopefully today we can bring a little clarity to that and how it impacts real estate, because obviously we're all somewhat interested in real estate here. So post-COVID, we've seen crazy soaring rates of inflation, as you see in this graph here. That green circle represents, since beginning of 2020, the consumer price index, which is the #1 indicator of inflation, has risen 7.9% year over year. We haven't seen a rise like this since the early 1980s, which is pre-modern REIT era. And so this current inflationary period is a result of the pent-up demand from COVID. And, a lot of stimulus was put into the economy. And so we have pent up demand. And, one misconception I even had before this presentation that Professor Harris cleared up with me was the fact that, a lot of this has to do with the war overseas right now, because war is often synonymous with inflation. But, as we see, inflation's been rising at a steep incline since pre-war. And so war definitely is right to be concerned for rising inflation. However, that's going to be accounted for in future CPI measures. We'll see it as, Russia and Ukraine are two of the biggest producers of wheat. A lot of Europe relies on Russia's natural gas. So that will kind of be baked into further measures. And then, throughout COVID, people were wondering, what is the Fed going to do about inflation? We need to combat it somehow, and that's the Fed's job. And so we saw the Fed was kind of predicting that inflation would be transitory, and, it was just kind of a during COVID thing. But as we now know, that was an incorrect prediction. And so the Fed has finally raised interest rates by 25 basis points. This is the first time they've raised interest rates since 2018, when they raised them from near zero. And they also predicted that they will raise interest rates most likely in the next 6 meetings. However, it is kind of a play it by year type situation based on how the economy responds. So Professor Harris, if you have anything to add for this slide?
Yeah, let me just add, as Jacob has pointed out, is that we've had a number of decades here, in fact, 40 years since we've had an experience of inflation of these rates in the United States. Obviously that peak you can see there in 81 was really, we saw the positioning of Paul Volcker, one of the most celebrated governors of the Fed, chairman of the Fed, come in and adopt very aggressive interest rates to curb the inflation. And basically, with a somewhat erratic trend, we've been basically in a downtrend for the last 40 years, with this last spike up obviously occurring in particular since in latter half of 21 and into 22. The interesting thing about 40 years is that means that there's only old folk like me of really any working experience of being in an inflationary period. So, many of the real estate investors, now some of them are kind of, you've got seniority even in excess of mine, but many kind of traders on Wall Street have no real experience of this, which actually means that, that's a little concerning that people are perhaps overestimating or underestimating what we're actually going through. I'm in the camp that the Fed has been at least 6 months to a year too late in doing this. It's only 2 months since they stopped actually buying US Treasuries at the long end and mortgage bonds. Again, without getting too much into the details, yesterday we had the Case-Shiller home price report, which told us that home prices are rising at 20%. Now, I know there are demand issues, but undoubtedly the fact that the Fed was buying mortgage bonds was adding fuel to the fire in terms of pushing up prices. And perhaps we'll discuss this a bit more in later. We don't have a separate slide on this, but I do want to obviously mention that, the big events that are happening in the capital markets at the moment, and normally the focus is on the day-to-day movements on equities, which is understandable because I think that there's a broader audience and it's a little bit more exciting, is the big events and dynamics that are occurring are really in the US Treasury market. And in particular, I think we might leave this to the Q&A or for discussion later, because I don't want to interrupt Jacob going through the slides. There's a lot of concern, a lot of debate about the shape of the yield curve, the US Treasury yield curve, and inversions, which are a sure sign signal. Every, I think, recession that we've had post-war has included an inversion of the yield curve, which is essentially the short end, so the shorter duration US Treasury is yielding more than the back end, the longer duration, which is 10 years. And I'm sure all of you students are aware, and everybody in the audience, is how critical the 10-year US Treasury is as a point of reference for valuing all asset classes, and in particular real estate, obviously. And so the fact that we've got close to either a flat yield curve or an inverted yield curve is certainly sending tremors through the market. Is this another sign that, or a sure sign that we're going to see a recession, or worse, actually stagflation in the next year, 18 months, as it has been a surefire indicator. And interestingly enough, whilst nobody would credit the US Treasury market with having the foresight to anticipate COVID, we actually inverted on the yield curve 18 months before COVID hit in early 20, which I think was a sign, obviously, that the market was getting nervous about the overall economic conditions rather than anticipating the pandemic. But let me hand it back to Jacob to take us through some more of the slides, and we can perhaps revisit the signals that we're actually hearing and seeing from the US Treasury market a little later, because it has a profound effect on the way real estate is going to be priced, and obviously more specifically on what we should be assuming by way of cost of capital and cap rates.
All right, moving on. So REITs versus the broader stock market. So we see, so I'll explain this graph a little bit before I get into the bullet points. So the dark blue bars are the price returns of REITs in the S&P, which consists of just the movement of the stock price. And then the light blue represents the income returns, which represents returns from dividends and interest rates. And low inflation is defined, I don't know, it's printed very small down here, but low inflation represents 2.5% or less. Moderate inflation represents 2.5% to 7%, and high inflation represents 7% or higher. So we see that in times of low inflation, the S&P just barely beats out REITs. And this is because when there's low inflation, the business performance of general companies outweighs the operating benefits that you get from REIT stocks. But moving to moderate and high inflation, we see that REITs often outperform the broader stock market, and that's for a plethora of reasons that we'll get into after. But yeah, so in 2021, REITs, I mean, if you've been following REITs at all, REITs have been on fire. Almost every sector of REITs was up in 2021 at record high numbers. All sorts of REIT activity was at record high numbers. So on average, the REITs beat out the broader stock market. We use the S&P to measure that. It's the 500 biggest companies. It's a good way to get a picture of the broader economy. And REITs outperformed the broader economy, stock market, by 12.5% in 2021. And this graph shows us that in times of high inflation, these red bars show that REITs on average beat out the S&P by about 5.5%. And yeah, so REITs, it's due to REITs operating performance that this happens. One thing that we should be careful when viewing this chart that Professor Harris briefly touched on is the fact that the modern REIT era started, I think we could say, like late 80s, early 90s, Professor Harris, if that's correct.
Most people would date it from the early 90s, so about 92, 93 would be considered the kind of start of the modern REIT era.
Exactly. And as we saw from the graph on the first slide, we haven't had a period of high inflation, even close to what we're going through now, since the early 80s. So that is one drawback of looking at it like this. But, we have to use the data we have, and this is just a preliminary way to look at it.
Yeah, let me just add, I mean, prior to, the REITs were formed as public entities, and passing legislation dates back to 1960 under the Eisenhower administration. So they had existed for a number of years, and actually decades before we got to the early 90s. But the market as we see today, populated by companies like Simon Property and Boston Properties and Equity Residential, to pick retail, apartments and office. Or if I'm getting the right order, I think retail apartments and office really emerged in that early 90s period. So as Jacob said, if you go back to 72, you had a sector which may have experienced operated in a higher inflation period, but really isn't any way comparable to the investment choices that we have today when we look at the REITs.
Awesome. All right, so here, the three main reasons that the REIT operating performance offers a great hedge to inflation. This is why, people tend to park their money in real estate, REITs as well, as a way for everyone to get involved in real estate investing. And REITs kind of in turn experience the same operating benefits that real estate has, since they are based on the performance of real estate. So without further ado, the rents and in turn NOI of properties and REITs tends to rise with inflation. This is due to the leasing structures of real estate. So for example, with multifamily, we have short-term leases with apartments tending to be about a year or so. And, with that, you can raise rents as prices go up. And it's kind of just at the market rate. It's not like it goes against the market. For longer term leases in industrial or retail, we often have built-in rent escalations that protect those assets against inflation as well. Sometimes even the leases will include escalations that are based off the CPI so that it's a direct correlation with inflation. So that's one of the main operating benefits to real estate and REITs to hedge inflation. Next, inflation reduces the real cost of debt, which is used in almost all CRE transactions. We know that commercial real estate transactions are very expensive, so oftentimes they're financed with leverage. And so basically what this means, maybe Professor Harris can explain a little bit better, but as you borrow debt and then prices are inflated, you're paying the debt down on what prices were when you originally took out the loan. So that's kind of how I like to think of it. It's you took out the loan when prices were lower and prices increased and you're still paying the same price on the loan. And then as costs are inflated, new development is obviously limited. Sorry about that. Because, the cost of building material goes up, the cost of labor, the cost of everything is going up. So it's not really encouraging new development in real estate.
Okay, just to step in and add a little color. On the first point, most economists, if you ask them, until relatively recently, would say, what's a good number to assume inflation over time. Most economists will tell you 2%, and of course that is in line with the stated goal that the Fed was operating with since it actually adopted a formal inflation target. And most practitioners, whether you're looking at development appraisals or working pro formas, would tend to start with a 2% type NOI growth derived from flat occupancy and rents. Now you can obviously play around with the models to get to some kind of a different number, but as I say, 2% is basically the number that most people would apply. And over time, we've found that in most property types, will be able to show those sort of growth, that type of growth. The debt deflation, Jacob, I think you made a good job of explaining that. I mean, most property transactions are financed with debt, up to 65% being kind of a typical norm. Mostly people use mortgage debt, and mostly those mortgages are fixed rate. So by definition, if you're paying a fixed rate mortgage over, say, 10 years, and your rent is rising over that period in time, if you've got an apartment, that's going to go up every year, hopefully. If you've got some longer leases, you may even anticipate, you've got annual bumps, or you've got kind of a rent review or releasing of a property. So you capture some increase in the income. So the income is going up at a time when your cost of debt remains flat. So that creates equity value. And I'm sure that many of you on the call have kind of worked through some examples as to how that actually plays out in terms of financing. And of course, when you've got that growth over a fixed cost base, leverage works to your advantage. Now, of course, it can actually go the other way, which is part of the risk and reward that we play. But for the most part, obviously, you tend to see that income tends to rise over time, and the cost of debt is you take the advantage of that fixed cost of debt. And then finally, obviously, on the point that again Jacob I think correctly spoke of, is and this is particularly relevant in today's environment where we're seeing very substantial increases in not only land to begin with, but also the other cost components that are so critical in terms of the development process. So the cost of raw materials, labor, and then interest charges. If a developer goes to the bank today to ask for a development loan, he's going to be asked to pay a higher rate of interest and get much less favorable terms than he would have done 6 months ago. So those are the 3 points which I think really underscore why property is seen as an inflation hedge. And if property as a whole is seen as an inflation hedge. Obviously, by association, the REITs offer this inflation hedge too.
Awesome. All right, moving on. So you may or may not know that the way REITs are set up, 90% of their net earnings are to be paid back to shareholders in the form of dividends. So this slide is basically to show us basically another example of REITs being a good hedge to inflation, as REIT dividend growth seems to typically outpace inflation. Like we said before, obviously, the numbers are just to be wary of, because we see this is from 2000. So again, this is this is postmodern REIT era, and we haven't seen periods of high inflation. But with that said, REIT dividend growth per share against the CPI has the REIT dividend growth has beat the CPI in all but 3 of the last 20 years. And annual dividend growth per share for REITs was about 8.4% compounded, while CPI growth was about 2% compounded, that goal number that we talked about. So this is just another example basically showing how REIT dividends tend to beat inflation and may be a good investment in the periods of high inflation that we're entering now.
So let me just add and give some explanation as to why we see a down number of over 20% in 2009, and then a really big bounce back in 2010. That, of course, was in response to the global great financial crisis, which hit in 2008. And the response that the REITs had was to cut their dividends. There was great concern that they would need to protect their balance sheets and to protect their financial flexibility. So many REITs actually cut the dividend. Many of them actually reported a decline in earnings, which allowed them to do that, given the REIT payout requirements. Obviously, Jacob identified, the REITs basically in a normal environment we couldn't cut the dividends because they have to pay out by statute their 90% of earnings per share. And then the big bounce back we got in 2010 was when things, the economy started to pick up again, and there was the companies realized that they weren't facing the end of the world, and that the capital markets opened up again for debt and equity issuance, and that many REIT dividends were restored over that last couple of years. And so what we're actually seeing in subsequent years, so in 2011, 12, etc., we're still seeing fairly high rates of growth, but we're kind of normalizing down to the rate of growth. And as we go forward, I think REIT dividend growth, given the statutory requirement to pay out the 90% of earnings should grow in the high single-digit type number in normal economic circumstances, without a recession or some other external impact. And so that should be kind of give you the trend line as to what we should expect by way of dividend growth. So if we take high single digits as really being sort of somewhere in that 5 to 10% range, and if we take a normal inflation rate of 3, and we're nowhere near that at the moment, but obviously the ambition for the Fed is to get us down to as close as we can. Maybe it gets to 3 over the next couple of years if we're in good shape. We're still talking about REIT dividend growth being double that of the rate of inflation, even if inflation stays at relatively elevated levels of, say, 3%.
Yep, and I think definitely something interesting to watch, since we keep mentioning this modern REIT era and how we haven't had periods of high inflation yet, is, if you extend this graph one more year, what's it going to look like with inflation having a very high bar, and will REIT dividend growth continue to outpace inflation? So that's just something to look for in this next year. Moving on.
I should just add, actually, before we go on to looking at the NAREIT subsector performance and overall performances, a very big reason why institutional investors, and in particular retail investors, like to buy REIT shares is the dividend yield. They're not. REITs offer a kind of total return proposition to investors, which is a combination of dividend plus dividend growth, plus some capital gain from the growth in the underlying business, which in this case we measure by way of a metric called FFO, funds from operation. It's a kind of loosey-goosey term for cash flow. Whereas you think about, say, a high-tech company, often they don't pay dividends. and often investors are looking for high growth. So all the return that investors are looking for is really predicated on the notion that you're going to get earnings growth soon, or before too long in the future. Whereas I say stocks like REITs offer this total return package, which is a combination of dividend yield and some more modest growth perhaps. And so we're kind of more aligned to sectors like, say, utilities or traditionally energy. Now that's kind of in a different place at this moment, but energy stocks typically have kind of offered a fairly high yield as well as some more modest growth in the short term. So those are the characteristics, and that's why the dividend growth is such an important part of the investment story, because that's going to be part of your return as you go forward, and that's critical to in the eyes of many investors.
Awesome. Okay, so this chart, just the overall NAREIT data about REIT returns by property sector. It's interesting because it shows us, as you see with the highlight 2021. I mean, you go down the list and it's just record returns in so many different REIT sectors. All equity REITs up 41%. I think, as we talked about earlier, that beat the S&P by over 12%. Obviously, 2021 was a very impressive year for equities as a whole, but REITs already beating the broader stock market by 12.5% with over 40+% returns is kind of unheard of. I mean, you go down the list and 80% self-storage returns here, regional malls making a comeback, 92%, even hotel and lodging, which was, very damaged by the pandemic, is up as leisure travel returns. So yeah, this just kind of demonstrates that record year by almost all property sectors. But then we go over to 2022 year to date, and we see that REITs are not performing quite as well. Again, the broader stock market hasn't been performing quite as high as it was last year, but the REITs are still down compared to the stock market, which we'll get to later. But yeah, so this kind of, we still see that lodging is up slightly here, as I think they might have been the sector to take the biggest, if not one of the biggest hits during the pandemic. So they're still able to recover a little as restrictions ease and leisure travel comes back. Still to be determined if we see the return to business travel to levels it ever was at. But yeah, so to segue, I'm going to use this chart to talk a little bit about why REITs are down this year. And I think, to begin, investors tend to be hesitant when interest rates rise. It seems to be like a red flag that goes off for everyone, even though interest rates need to rise to combat inflation, as we talked about. But just in equities as a whole, even though, we're talking about REITs are a great hedge to inflation, all that, just the interest rates rising definitely make investors a little hesitant. And beyond that, we've seen cap rates rise, which makes investors hesitant in any type of real estate. Professor Harris, maybe you could talk a little bit more about the cap rates rising and how that's made investors hesitant.
Yeah, I think there's another slide that also kind of overlaps this in a couple of slides further on. So, but yeah, to give a little bit of background to this. So we saw this very strong performance of over 40% gains in last year, but that was off a very poor year in 20. When, if we remember, when we suffered early in the year, late February, early March, we saw the lockdowns and the response to COVID, which in many cases actually meant places like retail malls and offices were empty. The malls were actually locked. Only essential retail properties were open. And so, the REITs really performed very poorly then. So last year was a bit of a rebound year. And in particular, we can actually see, as Jacob identified, shopping centers up 65%, regional malls basically doubled at 92%. You see some other very strong performance, apartments 63% up, single family homes 50%, and then self-storage, which kind of actually proved to be kind of a much stronger performer, I think, than many of us thought. But again, I would classify many of the stocks that outperformed the sector. So these are REIT stocks that outperformed the actual overall REIT index as rebound stocks. So with as the economy reopened and places like malls could reopen and Gradually, we saw reopening of things like hotels and return of some degree of travel, at least on the leisure side. Some of those stocks really did quite well. What's interesting is that if you look down here at the bottom of this chart, you've got infrastructure, which is basically another name for cell towers, and you've got data centers, which is data centers, obviously. So these are kind of very much in what we call the tech related. And I think you could probably throw in industrial, which is probably the biggest misnomer that we use to describe any property type, because there's very little industrial goes on in industrial property. It's virtually all distribution warehousing. And obviously a lot of that is now tied, the sexy bit is really tied to e-commerce. Now there's still lots of space given over to more conventional goods and service goods, I should say. But definitely that's really been one of the hotter sectors, and that, as you can see, it's up 62% in 21. That was not really a rebound. That was a sector that did well. In 20, just going back on data centers and cell towers, those sectors actually were really strong performers because, of course, we were very dependent to work from home and to entertain ourselves with Netflix on data centers and cell towers working for us. And they continued to be, their businesses tended to be, and their earnings tended to be very little unaffected. In fact, I think if anything, they produced probably stronger earnings through COVID, the COVID 20 year, than they did. So fast forward to last year, and they kind of, retreated a little bit and underperformed. Still positive performance, but underperforming the overall index. And then fast forward, we've actually got, and I think we're going to probably talk about this in a couple of slides. If I talk a little bit more about what's happening in today's environment, why REITs would be down when you would have said, looking at and hearing as what we've had to say on our earlier slides, why aren't investors piling in to buy in essentially what is a pretty good inflation hedge? And I'll try and give some explanation as to why the market is not taking that view in the short term.
All right. So like we just touched on, so I guess here's a slide of REITs here today. Oh, sorry about that. So yeah, so REITs since start of 2022 have underperformed the broader stock market by just about 3%, which is obviously a big change from last year. And so we touched on the fact that investors are hesitant as REITs rise, and there's a major sell-off taking shape at the beginning of the year. And then I think so Professor Harris was going to explain a little bit more about this hesitancy to begin 2022.
Yeah, so you can actually see on both these charts, particularly if you look at the S&P performance, we've actually bounced back off the lows of about a month ago. And we've kind of recovered probably about half of what we lost this year. I think last looked at, I think the S&P was down about 5%. The REITs, we've had a little bit of a bounce back, but it's not been as pronounced. And to explain why people have really not piled into REITs as an inflation hedge, there's as some other areas of the market have enjoyed, is that that when people see such a sharp movement in terms of sell-off or high yields in the U.S. Treasury market and fixed incomes generally, there's an immediate sort of concern amongst general investors who do not specialize in looking at REITs and real estate all of the time. There's an awareness that there's a rate sensitivity in terms of the cost of capital, in terms of potential erosion of prices through higher cap rates. And what about my dividend yield? If I can get now 2.5% for my 10-year, and it was only 1.5% at the beginning of the year, then at the margin, why should I be looking to buy REITs at 3%, right? Still above what you're going to get if you invest in the 10-year today, but the spread has come in, and at the margin, people are going to reallocate capital and say, okay, 2.5% 10-year, which is essentially perceived as the no-risk investment, it was going to attract a little bit more money. The other thing that's gone on is, and again, it goes back to those tech-related sectors that I was just talking about, is they were the REITs, the tech-related, if you aggregate them together, so it's the data centers and the cell towers. I'm not really including the distribution space because that's sort of it's not fully tech, but those were, the biggest sectors in the subsectors in the market by weight, by weight in the index. And what we've seen this year, and particularly in the early part of this year, and we saw there was real pressure on a lot of the tech-related stocks. So NASDAQ, which is tech-heavy in terms of the companies, and their weighting in that index was getting pounded as people looked at a higher discount rate that they're going to have to use to discount future profits. So not only when we see interest rates rise dramatically as they have done, so we're up, as I said, we've seen the Fed funds start to move. There's anticipation of how much that's going to go, big debate as to how much that's going to go. We've seen the 10-year Treasury yield move from 150 to 250. We're actually trading at about 235 today, so it's bounced a little bit in the last couple of days, but we were pushing 250 only the end of last week. So we're basically 100 basis points up. And so those are very dramatic moves that the market is kind of pricing in. And that had a pretty negative effect, and particularly on people's discounting of these future profit company, high growth companies. And of course, for general investors, they would look at an American Tower in the spell space or an Equinix in the data center space and say, oh, those are, not only REITs where I'm buying these things for yield, but are also tech related. And so that really put pressure on. And so that I would argue is the reason why we're underperforming the market by 11 to 12% at the moment, and the market is down we're down about 11 to 12% in absolute terms year to date, although it's coming back a little bit, and the overall market is down about 5% as we go forward. There's another debate about whether the overall market is not being over optimistic, but I'll kind of leave that for the Q&A or any subsequent discussions that we might have.
Real quick, just something you touched on that I think would be good to relate to any undergrads on the call is you talked about that spread between treasuries and cap rates, and that's something we talk about in market analysis class that every undergrad has to take all the time. So, in that class, as we talk about when the spread between cap rates and treasury narrows, then we see more hesitancy in real estate as, people think, well, I can just park my money in treasuries, which is one of the lowest risk, U.S. Treasury is one of the lowest risk investments out there. So when the spread's smaller, it's, more hesitancy for investors to risk investing in REIT stocks or real estate as just the U.S. Treasuries. So that's just something to relate back to something we all learn a little bit about in class. Moving on, REIT M&A and go private activity. Theme of the call is 2021 REITs were on fire, record year for M&A volume, reaching about $140 billion, combining strategic M&A and go private activity. One of the biggest drivers of this, as we see in the top right graph, is the average deal size for REIT M&A from the past decade was about $3.5 billion to 2021. We started seeing huge deals consistently at around the average of $7 billion. Another contributor to this is many deals were done with limited marketing, so that helped simplify getting deals done. M&A deals can be very complex and take a long time to get done. So with limited marketing and people snapping up the deals quickly, it allowed M&A deals to be done with fewer bidders brought to the table and just more efficiently. And then the outlook for M&A with REITs and go private activity in the future year 2022. Some indicators, point to M&A slows as interest rates rise. The cost of borrowing to complete these transactions goes up as interest rates go up, obviously. But one thing that keeps us remaining, I guess, bullish on REIT M&A activity is that along with record go private activity, private equity funds have had record years of fundraising and are loaded on dry powder. And like we said, with high inflation, they're going to be looking to place that money in something that'll hedge inflation. What's better than real estate and REITs? And so we see that M&A should, even with higher interest rates, we're expecting it to keep up at pretty high volumes. And then another example of why REITs should continue to have high M&A volume. We talked about the digital economy and the transition to a digital economy and how that's seen in real estate asset classes continuously going up, like data centers, infrastructure, and industrial. And we see that companies are trying to gain a lot of market share in these like smaller niche areas of real estate. For example, in 2021, we had 3 REIT data center acquisitions that totaled $35 billion of just 3. These are the 3 largest data center REIT acquisitions to date, with KKR acquiring Cyrus One for $15 billion. American Tower, which is a cell tower REIT, acquired CoreSite, which is another data center REIT, for $10 billion, along with Blackstone buying out QTS for $10 billion. So we see, you know, these big private equity funds trying to gain a lot of market share in these niche areas of real estate.
Yep.
Is that anything else, Professor Harris, or moving on?
Well, the only thing I would add to that, yes, the private equity, you know, there's liquidity in the private equity to finance these transactions is a strong argument in favor of the view that we're going to continue to see M&A activity run at a high level. I'd also say, and M&A, by the way, for anybody not aware of what M&A is, merger stands for mergers and acquisitions, by the way. So just by way of explanation. But the other thing that is going on is amongst the companies. So this is what we call public to public. So where you see 2 public companies merge, usually almost invariably in the same property type. There has been a tendency for Wall Street investors to kind of like bigger companies. You can usually get there's a few economies of scale to be had by way of, you know, cheaper access to debt, cheaper cost of like G&A in terms of running a public company. You know, we can debate as to how much operational benefits you get from being bigger. You know, it's probably less than most other businesses, but increasingly, you know, larger companies in terms of your abilities to buy and sell the shares in the stock market. So that we call that a liquidity premium, have commanded a higher value in the eyes of investors than smaller companies. So we've seen, you know, 2 medium-sized companies get together in a certain property type and become, you know, the dominant player, or 2 smaller companies become a medium-sized player. And so this process of consolidation has been a fairly substantial driver of M&A activity. And I think that will probably continue to be a bit of a driving force in activity through 22, notwithstanding this, obviously this increase in rates, which should be causing people to pause a little bit in terms of, you know, doing big deals like this. But I do think that will pass a little bit, and we'll overall over the year, I think we'll probably look back and think about quite a large number of deals that have gone down. Okay, I think that brings us to the end. Okay.
The end. Bios, me and Professor Harris, if you care to look. All right, so yeah, if you have any questions, let's go ahead and put those in the chat box. We can ask Professor Harris. I can get that started with a discussion question I have for Professor Harris, just to while you guys preparing any that you may have. So Professor Harris, one thing you and me have talked about in depth, and we're looking forward to the next year, is what property types are going to be relatively attractive investments at the times of elevated inflation, and what is going to be less attractive as we enter this inflationary environment.
Yeah, so in fact, I think you kind of made reference to this in the prepared remarks, Jacob. So, you know, companies that own properties with short leases. So we kind of think of obviously hotels. Now, hotels have got a bit of a challenge at the moment because of COVID and the slow recovery in business travel, but leisure is definitely picking up. We have to hope that we're through, you know, no repetition of waves of COVID that slows everything down again. So those obviously the shortest leases where we mark to market essentially every night. You know, apartments are basically a year-long leases. And then there are other property types. Self-storage is on a month-to-month basis, although many tenants seem to stay for a little longer than that. And so those areas are going to should be fine. Now, obviously, if we hit a recession, which we can talk about perhaps in another context, you know, those are the areas where you're most risk of rents going down and occupancy being lost as well. But the other areas where which are going to look least attractive are obviously longer leases with flat leases. So if we're talking about elevated inflation, and I would define elevated inflation as really anything being over 3.5, and I think we're going to be at that level for some little while, like a year or two, in my judgment. Then flat leases that don't allow for any increase on a year-to-year basis are going to look are not going to look particularly attractive. So now there are companies that obviously typically see on longer leases annual bumps. We've got to 2% in many cases on a lot of new leases. There aren't too many CPI leases, so it tends to be annual bumps and 2%. And I'm hearing some people landlords are pushing for a little higher. But even if you get a little higher, say you manage to get 2.25, 2.5 on a yearly basis, you're still talking of being a country mile short of a 7% inflationary environment. You're still short of a 3.5% inflation environment, which I just referenced. So you've got a real decline in your real income over a period when inflation is going to be running in excess of your rent. So longer leases aren't going to look too great. Triple net activities, which is in fact covers a lot of newer sectors in the REIT market, are also going to be a little under pressure here and less attractive. And then longer term, the impact of higher rates, you have to think about what the impact of higher rates on the way it's going to play out on the economy and the way the Fed is going to respond is higher inflation, I should say, is going to almost certainly result in the Fed raising rates. And then you've got the flow through to cost of capital. So your debt capital goes up immediately when rates are raised. And then subsequently, you get the impact on cap rates, the upward pressure on cap rates. Now, in my experience, and I would certainly, stand to be counted on this, but in my experience of having lived through several cycles, there's usually about a 6 to 9 month time spread between sharp movement up in interest rates and your cost of capital and any impact you'd see on cap rates. But obviously, as I've said, the 10-year, which is the reference point for mortgage debt, is up 100 basis points from a 150 start. So that's a material cost of, if you're financing a deal with debt to 65%, and you're probably going to have to put in a higher equity cost as well, is you need an awful lot of NOI growth to compensate you for the upward pressure on cap rates in that period in time. And so we've got to be a bit aware. Now, offsetting that, as you mentioned, is we do have this excess liquidity that's sitting out there with private equity. And I'm not hearing, and there may be other people in the audience, and Scott, certainly Professor Robinson may have some experience of this, is I'm not hearing of any cap rates actually moving at the moment. Normally you see buyers just pull back and say, I can't really afford that, and the sellers are reluctant to take down, and so you get this kind of standoff, which in a normal cycle would be, I say, it's we don't act like the derivatives market or even the stock market in terms of instant responses. In real estate, it takes a while for things to work out, for better or worse, and so I do think it's going to be the third quarter, the fourth quarter before we actually start to see things softening in terms of cap rate movements up.
Yeah, no, look, I have a client who's looking to acquire an office building, 50% discount from what the seller paid for it. And the conversation is absolutely not about inflation. It's about return to the office. I'm not hearing inflation as part of the private market transactions just yet.
Awesome. All right. So question from Professor Harris, the REIT man himself. What percent of the current inflation do you think can be successfully managed through Fed actions? We talked about the inaction by the Fed for the majority of COVID. So we're finally seeing the Fed cracking down and actually taking action to raise interest rates and to, halt the buying of more bonds and treasuries. So Professor Harris, what percent of inflation do you think Fed can actually successfully manage?
Well, that's a question less for a REIT man than an economist or one of the members of the Fed, the FOMC. I mean, I'll give you my best guess is that currently the Fed's own forecast, which they publish every other meeting, is suggesting that we have this terminal rate, so the highest point of Fed funds rate, which is the short-term rate that they manage. And we've just popped that up from 0 to 25 basis points. We end at 2.8 at the end of 23. I fear that the inflationary pressures that we've got, there are some transitory pressures in there, like if you look at lumber, it's coming down. The spike that we saw in cars, both new and old, new and used, I should say, is starting to come down. So I think the supply of the goods that has been this fuel of inflation. We're not even talking about the war, by the way, the Ukrainian war situation. We're talking about the supply constraints leading this jump up in demand for goods. I think the market will actually work that through, and we will see some elements of transitory inflation kind of mean that some components are working down. But then if you think about what we're seeing in terms of wage increases, which is running at 5, and we're going to get the job numbers actually for March and February. So on Friday, I should say, for the March numbers coming on Friday, and we're going to get another look at that. My guess is that number is probably staying at 5. So that in itself, you're getting wage inflation, which is part of the economy, and that's also having will have an effect on the service side of the economy, which is 60%, 60% of activity, economic activity, service related, and labor costs are a big part of that. So I think we're going to get feed through. So, the bottom line is, I think the Fed is going to have to move further on rates than is being priced in at the moment. And, the risk, we got 7% inflation. The Fed's late to the game, so behind the curve, as the jargon has it. And I think they're going to have to put rates and be more aggressive on the quantitative tightening, which is selling off the securities that they've got on the balance sheet. And so I think we're going to have tighter monetary conditions, and the risks of overdoing it and putting the economy into a recession, I think, are not inconsiderable. So I don't want to get too gloomy, but I do think the chances of us entering a recession in 23 are not trivial.
Great. Okay, so I think we have time for probably 1 to 2 more questions. Next question, of course, I'm 21 years old, still getting embarrassed by my mother as she has posed a question to everyone. I think it's a good one though, so I'll read it out. Do you think the uncertainty about future inflation rates is likely to lead to more floating rate debt and less fixed rate debt, reducing the ability of borrowers/investors to benefit from the spread between debt service and inflated rent revenues?
Well, for the debt providers, the lenders, they'd be very keen to put as much variable debt out at the moment. But for the borrower, it's a very risky proposition. So there's going to be a kind of a tussle between the two component parts. I mean, you could see variable debts with some kind of caps put in place as a sort of somewhat of a halfway house between the two component parts. But I mean, I'd certainly, if I were a developer at the moment, well, I'd be nervous about starting a development where you could be looking at a recession in 18 months. and I'd be very nervous about taking variable debt out at the moment, simply because as I said, I'm fearful that the Fed is behind the curve, and I think the market may be underestimating, how far the Fed has got to go in terms of raising rates to curb inflation. And again, the data we've seen so far has not included really the inflationary impact of the Ukrainian war, which, as you pointed out, is putting upward pressure on energy as we speak. And then obviously there's the food element to this as well, which, for anybody that, does the grocery shopping, as I do in our household, you're seeing, substantial increases already in terms of food products. And those that, remember, the political dimension to this and why it's putting the heat on Washington, I think, is, whether you're filling your car with gas or whether you're buying your energy, your food at the supermarket, or indeed if you're contemplating, putting a roof over your head, whether you're buying, when I talked about 20% price inflation on housing, and rents are rising in many cities at a rapid rate as well, is you're facing those inflationary pressures every day on basic commodities, which is why I think there's, we're putting the heat on Washington and the politics, and why that's actually having sort of panic stations run riot at the moment in terms of, we've got to do something, But the Fed's ability to control inflation, it takes a time. It's going to take, even if they'd been moving earlier on this, we'd still be facing a high inflation, which was going to take time to rein in and bring down. They may not have let the labor market and the cost element of labor kind of take root as it has, but by being late, there's a risk that you're getting this, inflationary expectations have been built up a little higher than would otherwise have been the case had they not been so dogmatically tied to it's transitory, it's all going to be over by the second half of the year. And that was last year they were talking about.
Great. So we have about 2 minutes left here. If there's any last final quick questions from the audience, feel free. Oh, got one. Perfect. All right. What strategies might investors and general partners use to keep high returns in a high interest rate environment, except the NOI growth, which cannot grow beyond a certain cap?
Well, I'm not sure I know the answer to that. I mean, I think the strategy, if you are kind of taking the more cautious view that I would do, is I think you need to be, very cautious about development, very cautious about variable debt and leverage on your balance sheet, whether it's in the company form or public company form, or whether it's in the private form. I think that going forward, my view is that there's going to be more focus on growth from real estate and REITs predicated on being the most efficient operator. So that's looking to maximize your revenues and filling buildings up and getting the top leases, keeping tenants happy and in place, and then obviously controlling your expenses to a great degree. Certainly Professor Robinson will know this, I think we've passed peak in terms of the private equity model, because I do think that model worked terrifically well while we were in a period of low inflation, which allowed interest rates and cap rates to decline. So we saw price appreciation, and the more leverage you use, the better the returns to your equity as an equity investor. If we're now in an environment where inflation is going to be hard to rein in, it's going to run at that 3.5% for some little while, then rates are going to have to go up and stay up. And then you're not going to be able to see, cap rates will have a tendency to move up. So leverage isn't really going to work for you. And I think you're going to fall back on people who have the best operating skills. And that's where I'm very confident that the REITs offer a competitive advantage to most of the other operators, whether it's institutions owning this through brokerage houses and agents, or whether it's private equity who've largely been staffed with deal doers as opposed to people with operating skills.
Just to add on, even though I'm not the expert here, but I did do some research on this for a Blueprint article. And a lot of what I talked about in that article was investing in real estate on a by asset class basis. So, while a lot of what we talked about is REITs and real estate performing well as a whole in times of inflation, it really depends by asset class. Real estate is way too broad to just talk about in general. We talked about multifamily with, quick lease turnover and only a year leases, allowing us to easily raise rents. Stuff like that is going to perform better in high inflation rather than, let's say triple net leases where prices of goods are going up and businesses aren't selling as much goods. So that is definitely something to look at. Investing in real estate on a by asset class basis and really just risk return ratios, using that to invest in times of high inflation. I think that's all the time we have today. Thank you, Professor Harris, for being the co-host. Thank you, Professor Robinson, for allowing Blueprint to do this as a lead up to the REIT Symposium. This is really great for us, and looking forward to hopefully doing it in future years as well.